Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I know yesterday I made a video on SPY and how you definitely should not be trading SPY. And I'm going to continue and pick on SPY again in this video, but with some new information. Check this out. So as you probably already know, SPY is like a basket of a whole bunch of things. So it's got a bunch of different stocks, so you own all these tiny fractions of them, right? So I'm looking at SPY online right now, and I'm looking at its top holding. So its top holding is Nvidia. 8% of the fund is in Nvidia, followed by Microsoft, Apple, Amazon, Meta, right? All these big names. So I'm going to give you an example, an alternative to investing in SPY. So first of all, I want to say that SPY, do you know how much money is in SPY? Do you know how much dollars is invested in SPY right now? $650 billion. What does that tell you? First of all, here's what that tells me. I said this before in other videos. When you do what other people do, you get what other people get. When you do what most people don't do, that's when you get what most people don't get, right? I am always looking against the grain, right? Like, I don't want to, all these people talk about like, oh my gosh, I invest in SPY. SPY is so amazing. Right off the bat, that's like red flag number one that tells you maybe that's not a great idea. So it's a monster fund, $650 billion. Last year, I think the past 1 year, it's made 16%. Now, some of you are probably watching this video and you're probably like, oh my gosh, 16%, that's pretty good. Okay, yeah, it is pretty good. I mean, I would say the average, S&P, the average stock, the market in general, on average makes about 8%, 10% per year. So like sometimes more, sometimes less. So on average, they say 10%. 16% is good. Okay, you know why it made 16%? Because the whole market was up last year. It's like the tide. The tide rises, all boats rise, right? However, it's not that, okay, 16% is good. Here's an alternative for you. Like I said, the biggest holding in SPY is Nvidia. Just trade Nvidia. Let me talk to you about Nvidia. So right now, Nvidia is $182 per share. You can do a couple different things. I'm going to give you a really great trade idea for tomorrow if you want. $182 per share, right? Do you want to pay sticker price when you buy stock? No, you probably shouldn't pay sticker price. It's kind of like when you buy a car, when you go to the dealership, do you want to pay MSRP? No, you want to get a discount. When you go shopping at the mall and they got some clothes and some of them are on sale, would you prefer to buy them on sale or regular price? Would you ever prefer to buy something regular price or at a discount? Of course you'd want to buy it at a discount, right? Here's how you could buy stock at a discount. And if you like SPY and you think it's so great, check out this comparison. Sell a Nvidia put. So I'm going to give you an example. I'm looking at my laptop here on the side of me. Today's Monday, the 18th of August. I can sell a Nvidia put that's going to expire this Friday, right? So only 4 more days, right? And let's say I want to sell a $180 put. What does that mean? That means that if Nvidia dips below 180, I'm going to buy 100 shares at 180. Now, where's the risk? I mean, maybe the stock goes to 175 and I'm committing to buy it at 180, right? However, right now it's 182. So I'm committing to buy 100 shares at a cheaper price than where it's trading at now, right? The premium, the price that you get paid for that commitment right now is $162, right? So here's what that means. You have to have money in your account to trade it. Now, you could use margin. If you don't use margin, that means you have to have $18,000 in your account. How did I get that number, Michelle? If I'm selling a 180 put, I'm committing to buy 100 shares at $180. 180 times 100 is 18,000. So if I want to be super conservative and not use margin, I have to have $18,000 in my account. I could use margin, and if I did that, depending on your broker dealer or whatever, but I'll give you an example. You have to have about $3,600 in your account to make that trade. What does that mean? That means that you have an account with $3,600 and they will let you make that trade. So margin is kind of like the broker dealer or the bank floating you the money, right? So you have $3,600 in your account, you can make that trade. So you have $3,600, you sell a $180 Nvidia put that expires Friday. $162 gets dropped into your account right now. You can spend that. This is so different. This is actual spendable cash, right? It's not like, you know, some paper gain, like I bought some Bitcoin and it went up and I can't take any of the money out until I sell my Bitcoin. Or it's not like I bought some SPY ETF, right? I invested in SPY and it went up 16% last year, but I can't spend any of that money unless I sell my shares. That is a fundamentally broken system. I'm gonna repeat that. Do you wanna make money, right? Let me ask you a question. Do you wanna make money so you can see some number go up on a computer screen, you know, from day to day, month to month, year to year, whatever, or you get a statement in the mail and, you know, oh my gosh, I started with 100K and I got 120. Or do you want to make money where cash gets dropped into your account and you can go spend that? Like right now is 7:30 Eastern time. I just got back from dinner with my daughter. We had amazing omakase sushi. For those of you who don't know what omakase is amazing at most places, many places. It's like, I'm not going to order my own sushi pieces, but it's like chef's menu, right? So the chef does these set menu and you eat it and it's always so amazing. And it's usually pretty expensive, but here's my point. Can I go buy some omakase sushi with this paper gain on my statement? You know, some shares that went up that I still have that I haven't sold? No, I can't spend that money. Can I go buy some omakase with some cash from selling a put? Heck yeah, I can, right? And that's what I did tonight. So this is what I mean. So you have to have $3,600 in your account. You're committing to buy 100 shares at 180. If it drops below 180, listen people, if it doesn't go below 180, you don't buy the shares, but either way, you keep the cash. $162. You can spend it any way you want. Now, by the way, what's the likelihood that Nvidia is going to go from 182, where it is now, to 180 before Friday? I mean, it's not a black and white thing, but the world is oftentimes mathematical, right? Probabilities, statistics. And I don't mean that in a boring, confusing, difficult to understand way. I mean, listen, you drive a car, right? Most people watching this video, you drive a car, you pay for car insurance. How does the car insurance company, how do they know how much to charge you? Like, you pay a different amount than I pay, right? So it's based on what kind of car do you drive? Where do you live? What kind of driving record do you have? Do you have a bunch of speeding tickets? Do you have a bunch of accidents? You know, those factor into the price that you pay. And the reason for that is because the insurance company, they don't want to charge like oodles and oodles of money, because nobody, you know, might not want to buy their insurance. Maybe they'll go to Geico or Progressive or something else. So they have to like charge their premium to make it attractive for people to buy their insurance, right? So what do? They try to charge money in premium and take in a little bit more than what they pay out in claims, right? This is kind of similar. So what's the statistical likelihood that Nvidia is going to go from 182 to 180 before Friday? It's about 34%. How do I know that? I'm looking at my computer screen. So when you trade, no matter who it is with, right? Interactive Brokers or E-Trade or, you know, Schwab or TradeStation, Tasty, Fidelity, all these different companies, typically they'll give you what the delta is. It's called delta. It's kind of like the delta has like a mathematical definition to it, but what I call the cheat sheet way of delta is like, what's the statistical likelihood that a stock is going to go from where it is to the strike price between now and the expiration date? So in this case, it's 34%. And mathematically, like, okay, that's only 34% likelihood that you're going to have to buy those shares. You can actually go lower. Let's say I want to commit, I don't want to spend 182. I don't want to even spend 180. I'm okay buying Nvidia at 177.50, let's say. I can sell a 177.50 put. Listen, guys, you are in the driver's seat when you sell options. You pick the stock, you pick the strike price, the price at which you want to buy that stock, and you pick the expiration date. It's got to go down below that price before the expiration date. You're in the driver's seat, and then you get paid. So worst case scenario, you buy a stock that you like anyway on sale. Oh my gosh. Like, listen, for those of you, $650 billion that is in SPY right now, you guys are all a bunch of suckers. Suckers. There's not another way to say it. Sell a put. If you want to own SPY, sell a put on Nvidia, sell a put on MicroStrategy instead. Do it that way, right? So let's say I sell a 180 put. I'm going to give you an example. I don't want to pay sticker price. I wouldn't mind owning Nvidia shares. It's a good company, a strong company. What's the rate of return? Okay, if I put up $3,600 and I commit to buy 100 shares and I take in $162 in premium, my annualized rate of return is 228%. 228%. Now let's forget about margin for a moment. Let's say I don't want to use margin and I want to be super conservative and I want to have 18 grand in my account, right? So I'm committing to buy 100 shares at 180 and I want to have, we call that a cash secured put. You're not using margin, you have the cash to back up the trade, right? What's my rate of return in that case? I'm using like a spreadsheet. I'm not a savant. I'm not like, calculating these numbers in my head. I'm committing to buy 100 shares at 180. So I have to have $18,000. I'm taking in $162 in premium. My annualized rate of return is 45%. 45%. That's still, listen, I just got done saying SPY made 16% over the last year. 45% is like 3 times what SPY makes. Why the fuck are you trading SPY? You're out of your mind. Okay, I'm going to give you another example. Let's say I think I gave this example yesterday, but I'm going to give it again. Let's say I want to sell a put on SPY. SPY, by the way, is $643 per share. Talk about like, risk, right? You have to have $64,000, right, to commit to buy 100 shares, right? Unless you can use margin and have less, but assuming you don't use margin, that's how much money you need. Let's say I want to sell a 33 delta, right? It's like got a 30% likelihood. That's a $640 put, right? So right now SPY is trading at 643. Let's say I sell a 640 put. What's my annualized rate of return? I'm going to compare. I wish I do have whiteboards all over the place. I wish I had a whiteboard to write down. But just stay with me, right? So Nvidia, I'm making 45% annualized return, not using margin, super conservative. Comparatively, I'm going to sell a put on SPY, the same type of thing. I'm going to make $190, right? I'm putting up $64,000. What's my annualized rate of return? Less than 15%, 14.98%. That's a third of what I can make with Nvidia. I'm risking a whole heck of a lot more, right? Because really you're committing to buy 100 shares at the strike price. 100 shares at $640, $64,000, right? Instead of committing to buy $18,000 worth of stock, right? And your rate of return is significantly less. Why would you do that? And SPY holds, the biggest holding of SPY is Nvidia. So just instead of like going through the middleman, just trade that. It's so interesting how people think. I was talking to a friend of mine recently. It's funny, like, I have lots of friends that, some of them, I don't want to say they don't believe in options, but they just, I don't know why, they just can't wrap their head around it. Like a friend of mine who has a bunch of money with a financial advisor, I don't know, like a couple $100,000 or something, and in like mutual funds and stocks and whatever. And I'm like, why don't you take a little bit of time and learn options, and you're gonna have way less risk. And for some reason, she can't wrap her head around the fact that, let's say, selling a put like we're talking about now has less risk than investing in, mutual funds with your, financial advisor down the street. I'm telling you, do yourself a favor, go against the grain. Don't do what 98% of the population does, right? Do what 2% of the population does, and then have the lifestyle that 2% of the population has. I mean, if you want that. Or if you want to like kind of keep chugging along and making 16%, I mean, that's not bad. But why would you make 16% when you can make 45%? Anyway, I hope that really hits home the differences between trading SPY, buying 100 shares of some ETF, investing with some financial advisor, which most of those people are no different than I don't know, kind of like a salesman, kind of like a car salesman, really. Lots of those financial advisors, I mean, they don't even know what options are, half of them, maybe more than half of them. And they don't know much about investing. They're just kind of like a salesman, and they make money off of you, right? Whether you make money or don't make money, they're still making money. Why would you do that? Like, learn how to put 10 hours of time and learn how to do it. It's so easy. 2 strategies, guys. Sell a put, like what I'm talking about now, and then sell a call. So let's go back to my Nvidia example. Let's say I sell a 180 put, and then Nvidia goes down, and then I have to buy 100 shares at 180. It's all good, because then I'm going to sell a call against it. So you make money on both sides. So here's the thing, guys. I don't want to be a fortune teller. I mean, if I wanted to be a fortune teller, I couldn't be a good fortune teller anyway. I don't know what tomorrow's going to bring. I want to make money whether the market goes up or whether it goes down or whether it stays sideways. Can you do that in stocks? No, you cannot. You trade stocks, you have your money in a brokerage account and some financial advisors managing it for you. Typically, like, you buy stocks, you make money when the stock goes up. That's it. If it goes down, you don't make money. And if it stays sideways, you don't make money. I mean, maybe if it pays dividends, you might make a little bit. But anyway, that's not the point. The point is you really only make money when the stock goes up. And on top of that, it's paper money. You can't spend it. You can't go buy some omakase at the sushi place down the street. It's a fundamentally broken system. Anyway, hit me up in the comments. Does this resonate with you? Does this make sense? Do you see how amazing options trading can be? Do you see how easy it can be if you just kind of like learn a couple basic things? Or do you want to stick with trading your SPY? Anyway, hope that helps. Happy trading.